After the government reported that GDP declined for 2 quarters in a row, many are asking whether we are really in a recession, given that the labor market is still expanding. In today's video, we're going to look at why there is no consensus on if we are in a recession or not, and we're also going to be digging into the GDP data for ourselves to get a better sense of where things are headed regardless of what you call it. Let's get into it. When it comes to whether or not we are in a recession, there are two schools of thought. And until this year, they both typically came to the same conclusion. And before, we hadn't had the current recession debate that's taken center stage this year. The argument for why we are in a recession has to do with the commonly accepted definition of it being 2 consecutive quarters of negative economic growth, which we now have. The Bureau of Economic Analysis, or BEA, the government agency that measures the country's gross domestic product, announced at the end of July that U.S. GDP declined by 0.9% on an annualized basis in the second quarter, which was on top of a negative 1.6% annualized rate in the first quarter. These 2 consecutive quarters of negative GDP growth fits the commonly accepted definition of a recession. But it's not being accepted this time around, and here's why. The National Bureau of Economic Research, or NBER, is the official arbiter of what constitutes a recession, and they look at more than just GDP. The NBER's traditional definition of a recession is that it is a significant decline in economic activity that is spread across the economy and lasts more than a few months. Given this definition, a lot of people point towards the labor market as one of the main reasons the U.S. is not in a recession. The latest jobs report from the Bureau of Labor Statistics reported that the U.S. added more than 500,000 jobs in July, and that was on top of job gains averaging more than 400,000 in 2022. To put that in perspective, the U.S. labor market has averaged 137,000 monthly job gains over the last 10 years. So right now we're seeing job growth more associated with a recovering economy than an economy in recession. It's a convincing argument, but here's the thing. Since 1949, every single time there's been 2 consecutive quarters of negative GDP growth, it has been associated with recession identified by the NBER. The only other time it was not associated with one in the available data is in 1947, but that was sandwiched between 2 recessions, one in 1945 and the other in 1949, so that was a bit of an anomaly. Whether we call this a recession or not does not take away from the significance of 2 consecutive quarters of economic contraction that we've seen. Okay, let's take a look at the actual GDP data, and we'll look first at what most people are pointing to as the main culprit behind the negative growth, and then I'm going to point out the big red flag not many people are talking about and how that could lead to a recession that even the NBER would have a hard time saying it wasn't one. One of the easiest ways to see what part of the economy is moving the overall GDP numbers the most is to look at the BEA's table giving us the contributions to growth for each sector. There's consumer spending, business and residential investment, international trade, and government spending. A brief look at these sectors and we can see right away what led the declines, and it was business and residential investment. More specifically, it was the change in private inventories, which took about 2 percentage points off of growth in the second quarter. This was labeled as the main culprit by many, and for good reason. The change in business inventories hit its highest recorded level at the end of 2021, and businesses have been trying to unload a glut of goods that built up last year. Big retailers like Target, Walmart, and others didn't anticipate the change in consumer spending on goods as inflation ramped up and are now trying to clear their inventories. This resulted in the big negative contribution to growth we saw in the second quarter GDP. Absent the negative contribution to growth from inventories, and GDP would have actually increased at a 1% annualized rate, and we wouldn't even be talking about this right now. So that's all well and good. This makes it seem like there's nothing to worry about. The economy's strong and adding jobs, and it was just a bit of a miscalculation by retailers that led to the negative print in the second quarter. Well, not exactly. See, there's a bigger problem, and it's the very reason retailers miscalculated how much inventory they would need: inflation. As goods and services get more expensive, consumers have to cut back on the quantity they purchase, and quantity is what the GDP measurement is all about. The growth rates we hear in the news are for real GDP, that is GDP that is adjusted for inflation. Looking back at the contributions to growth for consumer spending, it only added 0.7 percentage points. It was so low because spending on goods took away a little over 1 percentage point from growth. It was only because of spending on services remaining robust that consumer spending made an overall positive contribution to growth. Consumer spending is by far the most important component in GDP. It made up 70% of the economy in the second quarter. If we continue to see inflation coming in hot, as it has for most of this year, consumer spending will contribute less and less to overall GDP as wages are not keeping up with it. That is when we will see a real recession, when consumers are so pinched by rising prices they'll have little choice but to forego most discretionary spending and focus on the essentials like housing, food, and gasoline. What I'm going to do for you is to release a GDP update video at least once a month, if not more, covering the latest economic data releases and what they will mean for the next GDP reading. So if you want to stay up to date on the direction of the economy, make sure you subscribe to this channel and hit that notification bell down below so you know right away when my next video comes out. And if you want to see more of my other content, check out my other channel, Real Estate Watch, where I focus on forward-looking real estate analysis for the housing market. And if you found this video useful, please give it a thumbs up to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.